What's up everybody? GenExDividendInvestor here. In this video I'll be telling you about the most famous female dividend investor in the world, known as the Grand Dame of Dividends, as well as the Dividend Detective, due to her unconventional investment strategy which focuses on a company's dividends rather than its earnings to value it. I'm going to tell you about the 7 criteria she uses to pick dividend stocks, an approach that on average beat the market even during down periods. So please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. I'm talking about Geraldine Weiss, the most famous female investor of all time, and who is known to play cards with her buddy Warren Buffett, specifically bridge. You know when your friend circle includes Warren that you probably know a thing or two about investing. I saw a stat that said between 2000 and 2016, a portfolio of dividend stocks that were picked using her strategies outperformed both the S&P 500 and Berkshire Hathaway, which is impressive because she retired in 2002, so her dividend stock picking strategy seemed to be timeless. She was born in 1926 and learned about investing by reading books, listening to her parents' conversations, and studying it in college. She graduated from Berkeley with a degree in business and finance and said she was heavily influenced by Benjamin Graham. In 1962, she attempted to get a job as a stockbroker, however companies wouldn't hire her because they didn't think a female could be successful in finance. The best the Wall Street Titans could do was offer her job as a secretary. So, undeterred and being entrepreneurial, she decided to start an investment newsletter with her broker, Fred Whitmore. Sending out snail mail newsletters was a useful way before the internet to get information to people. As she and Fred sent out their investment newsletter called Quality Trends, they noticed that when it was signed with Fred's name they got responses, but when they signed it with her first name they did not. So it seemed that investors, like brokers, did not think a woman could invest successfully. They decided to just use her first initial and last name to hide her gender on their investing newsletter. Geraldine's core investing thesis was that there is a strong relationship between a company's ability to pay dividends over time and the performance of the company in the stock market. More specifically, her investment strategy looks closely at a dividend's yield to determine value of a stock, and a repetitively high yield would indicate an undervalued stock, and a repetitively low yield would indicate an overvalued stock. So she basically put a big focus on dividend yield patterns as a way of evaluating a stock. She kind of disregards companies' earnings because she felt it was too easy to manipulate in financial statements. She once said, "A clever accountant can make earnings appear good or not so good, depending on the season or the objective. There can be no subterfuge about a cash dividend. It's either paid or it's not paid." I read one analysis that summarized her approach as, buy shares when dividend yield is within 10% of its highest historical value or at its highest point in the past 5 years, and sell shares when dividend yield is within 10% of its lowest historical value or bottom in the last 5 years. You might have noticed that when I'm evaluating companies, I always show the yield patterns. Let's take a look at Altria's yield history using my dividend spreadsheet tool to see what I mean. Okay, let's put in Altria here. And then let's go look at the dividend yield trend. Now remember, dividend yield is the amount of dividends that pay out in a year divided by the current share price. So if the dividend yield line trends up over time, like we see with Altria, that means they are raising their dividend faster than the share price is being raised. If the dividend yield line trends sideways, that means they're raising the dividends about in line with how much the stock price goes up. And if the dividend yield line trends downwards, then that means the stock price has gone up faster than the relative amount they're increasing the dividend. So in Altria's case, we see that they're raising their dividend faster than the stock price has been raised, which means the yield keeps on increasing. If you look at 2016, Altria's yield got down to almost 3%. Yet today it's around 7%. So if you think that Altria's business is still robust, then you might think that the stock price is lagging relative to the actual value of the stock when you look at this metric in isolation. Or to look at Altria in Geraldine's lens, you might say it's a buy. Of course, another way to read a rising yield chart is that the public also sees some risk with the stock, which in this case probably pertains to trends people see in those sin stocks where consumption is generally decreasing in most parts of the world. Of course, the counter perspective to that is that people are probably overreacting that sin stocks like this are dying and are leaving good money behind. For a blue chip company, you can start to see why she puts a lot of focus on dividend yield. Over time, as her newsletter proved to be able to make people money, it got a bigger and bigger following, which then prompted more and more radio shows, newspapers, and finance TV shows to try to get an interview with her, not even knowing that she was a woman. She resisted going on TV until about 15 years after she started her newsletter, and then she went on a popular finance TV show called Wall Street Week, where she finally revealed that she was a woman. But at that point, her subscribers were so happy with their returns that they really didn't care. Through the years, she became more and more famous, appearing in Barron's, The Wall Street Journal, Fortune, Forbes, The New York Times, Market Wrap, Moneyline, and CNBC, amongst others. So there is more to her strategy than only yield. Specifically, she has 7 criteria to determine if a stock is worth investing in, with the last criteria being composed of 6 sub-criteria. These criteria to pick a stock are: number 1, whether the dividend yield is undervalued on a historical basis; number 2, whether the company has raised dividends at an annual compound rate of at least 10% in the past 12 years; number 3, whether the company is trading at a book value of 2 or less. The price-to-book ratio has been favored by value investors for decades, and traditionally, any book value per share under 1 is considered a good PB value, indicating a potentially undervalued stock. However, value investors often consider stocks with a PB value under 3. Number 4, whether the company has a PE ratio of 20 or less. These can be hard to find these days. I think Altria is around a 20 right now. Number 5, whether the dividend payout ratio is 50% or less. This is a lower value than I personally look for, and certain industries can run hotter, so I would treat these as guidelines. Number 6, whether the debt is 50% or less of the company's total market cap. And finally, number 7, whether it meets the 6 blue chip criteria, which are: number 1, dividends have been raised at least 5 times in the last 12 years. I feel this is too low of a bar for me. Number 2, has at least an A rating from S&P. Number 3, has at least 5 million shares outstanding. Number 4, has at least 80 institutional investors that hold the stock. Number 5, has at least 25 years of consistent dividends. And number 6, has shown earnings improvement at least 7 times in the last 12 years. So maybe she does look a little bit at earnings. Since her 7th criteria is kind of like 6 criteria, I guess you can say she has 12 criteria, though formally she says she has 7. When a stock meets all 7 of Weiss's criteria, the stock is categorized by Weiss as a buy. Weiss has 3 main reasons to believe that dividend yield is the best measure of value. Number 1, dividends result from revenue. Number 2, a tendency to increase dividends is a growth notice. And number 3, the repeated margins of dividend yields, reliable models of underestimation and overestimation. Now, you have to pay to be a part of her newsletter these days, but I found a 2012 article that seemed to indicate these were the dividend stocks on her list at that time. So it included Abbott Laboratories, ticker ABT, Archer Daniels Midland, ticker ADM, Aflac, ticker AFL, Chevron, ticker CVX, Coca Cola, ticker KO, CVS Health, ticker CVS, Eaton Corporation, ticker ETN, Emerson Elecrtric, ticker EMR, Johnson & Johnson, ticker J&J, Medtronic, ticker MDT, Northrop Grummon, ticker NOC, Union Pacific Railroad, ticker UNP, and United Technologies, ticker UTX, which is now Raytheon Technologies, ticker RTX, and of course the spin-offs of Otis and Carr. You may notice that most of these are boring old dividend aristocrats, thus I think you could characterize her investing as more safe and boring rather than high growth, which is how I think most people would characterize classic dividend growth investing. Now, a common question I often get asked is how many stocks should you hold in your portfolio? Well, Weiss recommended only 10 to 20 stocks, which is enough for diversification but not too much that you lose touch with them. So as soon as stocks hit Weiss's criteria, which a big factor was when a stock's price to its dividend ratio was low enough, she would advise her readers to buy. Then when the stock prices went back up, her readers might sell their shares for profit. For her, some conservative stock trading is an important part of her strategy. She advises that you monitor the dividend levels and adjust your portfolios to ensure you only include stocks that are paying at historically high levels relative to a share price. That's a more aggressive sell strategy than me, who rarely sells, though I did do a video called When to Sell a Stock where I explained when I sell. So how has she performed? Well, she had an evolving portfolio that was tracked in her newsletters, and the arithmetic average annual return for her portfolio of dividend stocks using her buy and sell strategies has been 13.26% as compared to the S&P 500, which was 7.66% over the same time frame. So that's quite nice. I think these days her portfolio is tracking around 11%. Here are her newsletter returns versus major indexes from 1992 to 2019 for reference. Feel free to pause it if you want to take a look. I'll also include a link to her website, which is iqtrends.com, which has some great videos that are worth watching. She wrote multiple books including Dividends Don't Lie, Finding Value in Blue Chip Stocks, and The Dividend Connection, How Dividends Create Value in the Stock Market. I'll include an Amazon affiliate link to The Dividends Don't Lie in the description of this video, as that is considered her best book. As an Amazon associate, I earned from qualifying purchases. So there you have it, the most famous female dividend investor of all time, Geraldine Weiss. Now I want to share a valuable life story, so listen carefully. There once was a company whose CEO was very strict and often disciplined the workers for their mistakes or perceived lack of progress. One day as the employees came into work, they saw a sign on the door that read, Yesterday, the person who has been holding you back from succeeding in this company passed away. Please gather for a funeral service in the assembly room. While the employees were saddened for their family of their CEO, they were also intrigued at the prospect of being able to now move up within the company and become more successful. Upon entering the assembly room, many employees were surprised to see the CEO, who was in fact present. They wondered among themselves, if it wasn't him who was holding us back from being successful, who was it? Who has died? One by one, the employees approached the coffin, and upon looking inside, each was quite surprised. They didn't understand what they saw. In the coffin, there was simply a mirror. So when each employee looked in to find out who had been holding them back from being successful, everyone saw themselves. Next to the mirror, there was a sign that read, "The only person who is able to limit your growth is you. You are the only person who can influence your success. Your life changes when you break through the limiting beliefs and realize that you're in control of your life. The most influential relationship you can have is the relationship with yourself. Now you know who has been holding you back from living up to your true potential. Are you going to keep allowing that person to hold you back? Moral of the story? You can't blame everyone else if you're not living up to your potential. You can't let other people get you down about your mistakes you make or their negative perception of your efforts. You have to take personal responsibility for your work, both the good and the bad, and be proactive about making any necessary adjustments. This story strikes close to home for me. Sometimes I hear my kids complaining about something, and I often tell them to look in the mirror and blame that person. Sure, I listen to what they say to see if there is something I need to dig into, but often it's excuses that they could have managed themselves. I see the same thing with investing. It's easy for me to blame the hiring numbers for not being what was estimated, for currency issues, for a lawsuit, whatever. That's just the reality of investing. That's the reality of life. Lots of things go wrong. You need to plan and adjust accordingly, deal with crap as it inevitably comes your way, and keep driving forward. Learn from your mistakes and keep striving to improve. To succeed in investing, you need to keep driving forward. When the stock market crashes, which I promise you it will, that's when you will be tested. That's when the naysayers will come out. That's when you'll be second-guessing yourself. That's when you'll blame the world or whatever. The reality is you made the decision to invest, now you own it, and if you have the stomach for it, and I pray you do, then you'll dust yourself off, realize that crashes are part of investing, and you'll get back on the investing horse and take ownership of your assets and decisions to keep moving forward. Okay, moving on. I'd like to shout out some of my latest Patreon aristocrats who have recently signed up. So thank you AirCDA, and thank you LMayo9. As an aristocrat, they gain access to my new dividend spreadsheet you just saw in this video, and to multiple private channels on my Discord, including one where I sometimes talk about my growth portfolio, and I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnail I should use for my new videos. And thank you to you, the viewer, for watching my video. Please consider hitting the thumbs up button, subscribing if you haven't, and click that bell notification. I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and is growing all the time. Thanks, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.